Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. Today I'm going to combine a couple of things. Sometimes I go over market conditions. I'm going to do that again. I'm going to go over gold and silver, do a technical analysis update, and I'm going to get into the nitty-gritty of some of this stuff. I'm going to give you my opinion. We're going to look at a lot of different things. Demographics, real estate, an expansion phase, how the expansion phase aligns with a commodity boom, how commodities are cheap in relationship to stocks, what the dollar's doing. Go into some ratios. We're going to look at copper to see if copper is a leading indicator of a crash coming if a crash were to come. We're going to look at the 10-year yield, and then we're going to look at a couple of charts in gold and silver itself. The market conditions are leading indicators of what gold and silver, precious metals and commodities, and even stocks are going to do. The way that this plays out, at least the drivers, is what I'm looking at. Beginning drivers, demographics, which drives real estate, and these two interact with each other. The supply and demand of real estate. Depending on where we are in the real estate cycle will depend if we're having a deflationary bust or an inflationary type move. It's the relationship between demographics and real estate, and where we are in that real estate cycle. The crashes, the deflationary crashes that people think of, the big crashes like the 1929 crash was actually a real estate crash in a couple years before that. In 2008, it was a housing market crash. The housing market is what has these large crashes. It's not from stocks. Stocks are just we'll call it the tail on the dog. The dog is the real estate market, which is the economic cycle. And that's what I want to get into here. Because if you understand that, that's your driver. Everything else is going to follow. At least that's my thesis, and that's the way that I view these things. So I think this is a really important update. I do have it as gold and silver. It's really market conditions as well, and what drives these things. So let's jump in here. I'm going to show you what I've got, and I'm going to voice my opinion here. So I'm going to start with the dollar and gold. The dollar at 8 a.m. really fired higher here, and conversely, gold got dropped off a cliff. So there is this direct relationship between the dollar and gold is nothing more than an accounting mechanism for the dollar. So when the dollar drops, gold is accounting for that drop in higher prices. It is inflation. Gold goes up during inflationary periods. Bar none, there is no whatever other thing that people tell you on YouTube, I discount it. I don't think it's necessarily correct because gold has only gone up because of inflationary pressures. That's the only time I see it go up, and I can show you in history what that looks like. Here's the dollar, looking a little bit closer. If you draw the line through these contact points through here, you have a breakout down of the dollar. If you draw it through this portion where you kind of come through this portion here and a little bit of hits through here, we still have a little bit of hope for the dollar to go higher. But what I'm expecting is this to decline. And again, this US dollar index is priced against a basket of other currencies. If that basket of other currencies is being printed at faster rates than the dollar could go up but still be losing value. Where we really see things take off is when the dollar is inflated at a faster rate than other currencies. And when this index goes down, that's when things really start to light up in the commodities complex. What drives this dollar? It's the real estate market that drives the valuation of this dollar lower and higher in its aggregate. It's really demographics and the condition of the real estate market. Because of the loans that go into the system against new real estate, residential real estate, because that is the majority of the loans. That is the driver of this dollar. Here's the dollar zoomed in. So what I'm looking at is this portion over here. We have lower highs and we have higher lows, barely lower highs, barely higher lows. It's kind of slowly consolidating in this channel that is slowly coming together. But it entered from the top, which means it could be a continuation pattern to the downside. Yes, I see the 50-day cross and the 200-day, but the underlying structural conditions are not there for a higher dollar on a long-term perspective. On a short term, we'll see. But I just don't believe it. I have to see this break to the upside for me to believe it first. And I'll show you the reasons why I think that. M2 money supply growth versus inflation. The M2 money supply growth, if you notice these moves right here, is nothing more than the real estate cycle. That's all it is. Inflation is lagged by 1 to 2 years behind the M2 money supply. It's a few years lagged. So you can see this move here is this move here, this move here is this move here, and so forth. Over here, they started doing QE all mixed in here and jumbled about from 2000 on. So this loses, it loses its direct connection. They can print money, but it won't directly affect inflation in some of these areas because there's no mechanism to get it into the system. It has to be loaned into existence. So the data from about, 95, 96 is when it starts to break down because they're in there jacking around with printing money and so forth. The real interest rate is just the difference between nominal interest rates versus the inflation rate, which is the real interest rate. So in inflation, the interest rate's the black line, inflation's the red line, the blue line's the difference between those two. And whenever we go down, so back here, when we went down, this is when gold would go up. Gold would go up when it went down. When this came back up, gold would go into a pullback. Demographics-wise, we imply 1.3 million new households per year. It's pretty steady, is what Goldman Sachs estimates going out to 2024. We have underbuilt. We're in an underbuilt scenario, and it's getting worse. So the demographics support higher home prices based off of this chart here that Goldman Sachs estimates in terms of new households per year for demographics in household formation. The shortage is the ongoing housing shortage is large and rising, in part due to the effects of the COVID-19 pandemic, which I don't believe. That is a false statement there, but our estimates suggest that the housing shortage, or that the shortage has increased 52% from 2.5 million in 2018 to 3.8 million in 2020. This number is right. I've seen this all over the place. This is Freddie Mac, but it's not due to the effects of COVID-19 pandemic. They are lying in that. This is due to the fact that we underbuilt all through this. This is housing starts. So we're looking at the housing starts information here. This is the thousands of units or millions of homes. 1.5 million is the average roughly. I've put some other data. The average is the blue line going across. We've got the real estate cycle going about the average up and down. That's the data there. The green circles are when commodity buy points, the commodity to stock ratio is a buy point. It's throwing a buy signal here, here, and here. The real estate expansion phases, which are pretty large, which means that you've got a large area under this curve, is in the red boxes. That's where the big real estate cycles are. Sorry, let me adjust this right there. So these are the cycles here. And then we've got another one that's just starting right here in this green circle, and we should be putting a box right here, the first line that we're going to start. We are going into an expansionary phase of real estate. Problem is, I don't know if we can gain much momentum up because of labor shortages and also material shortages. So I think that we can't build 2.4 million homes like we did back then. I think we're going to stay somewhere in this general vicinity up here. But we are in a buy point for commodities in relationship to stocks. We are in an expansionary phase, just like these phases back here. And I'm going to overlay these red squares over other charts to show you the alignment, to show you how this all aligns. And the green circles are nothing more. I grabbed it from here. When commodities are cheap to stocks, we want to buy commodities. Buy point, buy point, buy point. We've never been this cheap in commodities in over 100 years. And I know this isn't a 100-year chart here, but if you look at the data and the analysis, it's over 100 years that we've never been this low. Those red squares, I overlaid it on the price chart of gold. Gold went up here, it went up here, and it went up here. That is nothing more than the real estate cycle and gold accounting for the money supply expansions. Every single time. What do you think it's going to happen this time? We're throwing a commodity buy signal, and a commodity buy signal, and going into an expansionary phase. That's called alignment. It's an alignment of everything that's about to come. These are the drivers here. And this is the valuation. So market conditions are here. The valuations are here. And the alignment of price movement comes next. And we're just coming up now to a big move. Copper price. Copper tells us if a crash is coming. We've been going in this large, a channel here. We broke to the upside in the 2000 channel. This was the last boom from 2000 to 2008. This is what happened. It broke out of a pattern. Again, we came to this flag pattern, broke to the upside, and we're about to break all-time highs in copper very soon. These patterns need to be broken. We broke this pattern here, which is signaling that we're going to fire off a new commodity boom. And commodities are cheaper than they've ever been. The alignment is there. The patterns are being broken to the upside. This is signaling an inflationary period's coming through copper prices. Inflationary periods coming through this ratio turning up. This is signaling an inflationary period, inflationary period, inflationary period, inflationary period, inflationary period is coming. We have complete alignment. Copper price zoomed in just to show you, yes, this could come down in the short term, but I don't think it's going to be long-lived. Not when you look at a chart like this. I'm just looking at this little tip up here, and this could be a shoulder, head, shoulder, and then maybe we come down, which the price projection move would be probably about 380 or something in the short term. But looking at the market balances is what I look at. The copper long-term supply demand, the dark line's demand growth, total supply growth, and this is the deficit in between these two. We have growing deficits since already. In 21, we have a small deficit, and it really starts to grow in 2023. So we could be a year or two out where copper prices really start to take off. I mean, really start to take off. Especially when they start getting the stimulus money out there. So, big chart pattern break, market balance deficit. This is what you look at as an investor. This is what drives markets. Prices will follow. 10-year yield. This should be going up. Looking at reverse symmetry. You break it here at maybe July right here. This side might match this side. And what do we have? We got these two wings. We came down in COVID. COVID was in March, the sell-off in stocks. Bonds and yields dove dramatically before it. It was diving, broke through this pattern, dove down. We have a problem. Copper, during that time frame, dove. It dove right here before the stock market sold off. It's a leading indicator. This isn't diving right now. It's not diving down. Yields. We've got reverse symmetry, so this is coming back just like this, and I bet you we're going to see it move higher here. I'm looking for a move higher. It was up 6% today, quite dramatic. Here's our downtrend line. We need to break that if we want to go higher on interest rates. Interest rates, I am proposing, is going to go higher. We just have symmetry in the chart that we're getting worked off, is my guess. The wings, so to speak, is what I call it. So I'm expecting this to break this downtrend. It might take some time. Double bottom. We got wicks on the bottom here. Buyers are down there. Gold to monetary base. I put those big square charts on this one to show you the alignment between a real estate expansion phase and the gold accounting for the monetary base. Expansion phase, expansion phase, expansion phase, and we broke out of this big pattern. It's a descending wedge pattern, which usually breaks to the upside. We already broke out. We did a little back test. Now it's go time at some point. These are big charts. They take time. The underlying fundamental conditions and market conditions that are backing all these charts are all in alignment. The question you have to ask yourself is, how is it possible that all of these charts are in alignment and have it not work? These are long-term charts, very predictable charts. So gold to monetary base matches yields, which could potentially go higher, which matches a copper price and copper fundamentals, which match for higher copper prices, which were about to break all-time highs, which matches the price moves, or matches the valuation of commodity to stocks, which matches an expansionary phase of real estate every single time. What do you think that alignment is going to do over time? That's the question, and how are you going to react to short-term price movements? Now, getting to gold itself, the price of gold, we are coming up in this pattern here. We have not broken the long-term trend line to the downside yet. We are coming with a downtrend line here. I just kind of drew that in. We break out of this 1850 up above 1900 and close up there for a week or two. I think we're gone. We're gonna move higher. I know in the short term, everyone's looking at price and trying to make judgments based off of short-term movements. I think that is an incorrect assessment of markets. I'm taking the big picture view. I'm looking at market conditions and the drivers that would drive gold higher. And the drivers are all signaling that a big move is coming to the upside. In the short term, I don't know. Don't know which way this thing's going to break. I think it's going to break higher or give you a false breakout so everybody's going to get you off guard where big boys can position themselves. They're going to position, and they're going to position long here because they know this. They know yields are going to go up. They know that market balances are jacked up in copper. They know the commodity index to S&P 500 ratio is cheap. Goldman Sachs does this stuff. They know the real estate expansionary phase is going to be inflationary, and we know we got a buy point in all alignment here. So that's the big chart right there. That's what we're watching. And does it even mean anything? Because we know what the drivers are doing. We know where this chart has to go. In the long term. In the short term, maybe the moratorium, maybe some forbearance, maybe some of this stuff cools it off a little bit. Maybe not. I'm not a believer in that, but some people are. And I could obviously be wrong on the short term here. But we know that we've got market deficits and demographics are going to drive home prices higher, which into an expansionary phase of real estate. Silver, same thing. We're kind of just going back and forth. We're right at the bottom channel here. Just hanging on barely. Platinum, if you draw the line through here, we could pull back even further. We could go back to $900 potentially. And even when we broke out here, it came right back into the pattern. It's not time yet to move on a lot higher, but the valuation's good. I'm a buyer of platinum. When we see if this reverses and turns into strength, I'm going to buy it wherever it is in here. It's cheap. And I've been buying it. I bought it in 2019. I bought it in here, in here, in here. I bought it in here, bought it in here. Came down. I bought the living poop out of it down here. And I would still be a buyer in here. GDX on a medium-term outlook trend line, and we're right there at the trend line if you use these guys as points. Right there. This is what it looks like zoomed in, bullish engulfing, bullish engulfing, bullish engulfing. We have a bearish engulfing here. Sellers came in, pushed this thing down. We do have a wick at the bottom. There's buyers down here. There's support down at 32.50. There's a bunch of buyers down here. We'll see if it holds. SILJ, here's our uptrend line. We're right there playing with it. Back and forth. Is it going to hold? We'll see. Zooming in on this section in here. We do have this bearish engulfing. We have bullish engulfing. So we've got a fight between the buyers and sellers in this area right here. They're dueling it out. Who's going to win? We'll see. EXK, bearish engulfing here. We got a little wick at the bottom. There's some buyers down here. That's what that wick stands for. It came down and bounced back up. Momentum's to the upside. Would I be a buyer here? I don't know. I'd wait. Probably see what's going on. Franco-Nevada looks really good. We broke to the upside here, and we're kind of coming back and back testing or retesting the breakout. So that doesn't look too bad. But I wanted to focus on the drivers here. And where my confidence comes from is the market conditions and the drivers. Demographics, expansionary phase in real estate. I showed you every time in those red squares, every time we've had an expansionary phase and an alignment of commodity to stock ratios in alignment like that, it's always gone up. Gold's gone up. Silver's gone up. Platinum's gone up. They've all gone up during those market conditions. What makes you think that this time is different? I don't think it's any different. I think it's the same. We have all the alignment that we had in history. Everything. Valuations for commodities to stocks. We're seeing copper go up and almost make new all-time highs. That's a commodity. It's one of the leaders. These things wouldn't be throwing these things. We're seeing really big, real negative rates. It's all in alignment to me. Now, in the short term, I can't tell you what's going to happen. But in the long term, it looks very favorable. Everything's in alignment. Everything is go. Now we just have to wait for price to follow. That's the way that I'm viewing these things. So that's my market update. I wanted to touch on the market conditions as well, so you guys know what I know and what I'm looking at and what gives me the confidence in this. I buy things when they're down. I don't chase price. Price is nothing to me. Value is everything, and market conditions, because market conditions is what rotates money. And when money rotates, it goes into undervalued sectors. And if you're in this undervalued sector and we can ride this commodity bull market all the way up, you're going to get a massive revaluation higher. Massive. We could see a 1,000-fold increase in purchasing power of one asset, which is commodities, versus the asset of stocks. Stocks go way down, commodities go way up. It could be a very big revaluation against those two assets. And that's what makes me excited. So hopefully you guys like this content. Give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.